and I'm very pleased to invite and to welcome all of you to our 2020 economic forecast presented by RBC. This is a very popular annual event, a bit different this year because we're meeting virtually and not in person as in the past. So as a friendly reminder, if we could ask everyone just to keep their speakers and their mics on mute while we proceed, that would be very much appreciated. We will have time for question and answer at the end of this morning's presentation, and we can certainly use the chat function as a prompt for those of you who may want to pose a question directly. I'd like to begin this morning by recognizing the contribution and generosity of our presenting sponsor this morning, our ongoing partner, RBC. Peter Choma and his team are here with us this morning, and they have truly been an indispensable partner to our chamber, and the support that you have provided to us over the course of this year is so very appreciated. So thank you so very much for all that you have done and for being with us today. At this time, I'd like to introduce Peter Choma, Vice President, Commercial Financial Services, Halton South from RBC Royal Bank. And Peter is joining us this morning to introduce our guest speaker. So Peter, over to you.
Great, thanks Carla, and good morning everyone. It's a pleasure to be here today and part of this important and timely conversation. As Carla said, as Vice President for the bank, for the commercial bank here in Halton South, certainly had the opportunity to speak with many of our regional business leaders, companies, and community members as we face these unprecedented times over the past 10 months. Despite the many challenges that our business community has and continues to face, there's an incredible capacity for adaptability, optimism, and ingenuity when faced with difficult times. We're pleased to have Craig today virtually with us to provide us his economic outlook for 2021. For all of us, 2020 has been a year that's tested us in more ways than we can imagine. We prepare to enter a new year in a very difficult, in a very different world in 2021. How we continue to operate our businesses, interact with our clients, and live our lives will continue to be very different and will absolutely continue to evolve. And that is why Craig's presentation and the conversation this morning is such an important one. And now I have the privilege to introduce you to Craig. Craig is the Senior Vice President and Chief Economist for RBC. And as Chief Economist, Craig leads a team of economists providing economic, fixed income, and foreign exchange research to RBC clients. Craig is a regular contributor to a number of RBC publications and is a key player in delivering economic analysis to clients and the media through economic department's regular briefings. Craig is a participant in a number of key RBC internal committees and is a member of the C.D. Howe Monetary Policy Council, the British Columbia Economic Forecast Council, and the Dean's Council for the Lazaridis School of Business and Economics at Wilfrid Laurier University. Please join me in welcoming Craig Wright. Craig, over to you.
Thank you, Peter and Carla. That's a very kind introduction. I think I was introduced once by a RBC colleague. This is Craig. He's our chief economist. He makes stuff up. So I appreciate the more fulsome discussion. I'm going to have a brief overview. I'm just going to lay the sort of stakes in the ground in terms of how we see the economic environment unfolding through the remainder of this year, but more a story about how next year looks. And then, as I suspect, there's in an environment like this, there are probably more questions than answers. So we have lots of time for questions. So I do encourage you to feel free to ask any questions. Any corrections are welcome as well, as we're all trying to figure out what looks reasonable in the current economic environment when reasonable is really more or less out the window. In terms of the economic environment, our view is we're transitioning from a recession to recovery, but it's still very much vulnerable and a tentative recovery, and that'll keep uncertainty high as we move forward. Over the near term, the direction for growth in really any country, let alone across Canada and any province, the near-term direction will be determined by the second wave and what importantly policymakers' response to that is in terms of tightening and loosening restrictions as we move through the final part of the year. And then as we get in the early part of next year and beyond, then it's all about the vaccine in terms of production, distribution, and take-up. And that's a wild card too in terms of how many vaccines are acceptable in the eyes of the public. So some risks out there, but what we see is continued sluggishness through the end of this year and probably the early part of next year, and then more convincing recovery as we get into the second, third, and fourth quarter of next year. So this year we had a very brutal recession, Q1, Q2, massive declines, and then we saw the big bounce back in Q3, just over a 40% annualized gain in GDP for Canada. That's the easy part. As you reopen businesses, obviously going from zero up gives you these growth numbers, but the more challenging part comes as we move forward. And we actually have a bit of a stall taking place in the fourth quarter. So fourth quarter this year, we estimate growth basically around zero. We've got a 1% gain in the fourth quarter. And for the year, that locks in a decline in Canada, about 5.5%, which isn't as bad as many had feared. The Bank of Canada, their previous forecast, they were looking for a decline of about 7%. So we have seen prospects improve, still very deep recession. And then next year, growth prospects have started to drift higher. We're currently looking for growth next year, positive of 4.5%. But there may be some upside risk to that now as we see the vaccine rolling out and hopefully continue to move forward as we get into to next year. So a challenging economic environment 2020, but better news as we move through 2021 with the rollout of the vaccine and continued support from both fiscal policy and monetary policy. So ongoing support from the federal government, some of the provinces, but also a tailwind of very low interest rates for a long period of time, and that bodes well for growth prospects as we move forward. Now, a challenge that's going to continue to face Canada is the external environment. Global growth prospects, at the start of the year before the pandemic struck, the IMF had a global growth forecast for this year of 2.5%. As the crisis evolved and rolled around the globe, they continued to take that growth forecast lower, and they got to a low point of a decline of over 5% for global growth, far and away the biggest decline we've seen in recent history. More recently, their latest forecast, a small upward revision, still a decline, but a decline of 4.5%. So it looks like the trajectory that were continued revisions down in terms of growth for this year stopped, and we had a modest upward revision, and then growth accelerating as we move through next year. For Canada, the challenges will persist in a slow growth environment. We're going to continue to see slow global trade, and we're also going to see continued soft commodity prices. And when you look at the global trade environment, we had seen slowing global trade even before the pandemic, and that was reflecting the rise in protectionist sentiment. And through the pandemic, we've seen that protectionist sentiment harden even further, and that is somewhat explainable. When a country has weak economic activity and high unemployment rate, it's often easier to sort of build walls rather than build friends, and we've seen some evidence of that. So global trade continues to be challenged. We do see it picking up as we move forward. And commodity markets, we have oil prices averaging next year pretty close to where they are today. So WTI about $45 a barrel. So not a very robust recovery for the energy market. We are seeing it's better than the negatives we saw early in the spring, but still as recently as last December, the forecast for oil, the average forecast was WTI $60. So yes, we see oil prices picking up a bit through the course of the forecast period. But still, I would argue at a fairly low level. So a key component to Canadian exports is going to continue to be challenged against a backdrop of continued weakness in overall trade flows. Now, there's some optimism as well as some concerns with President-elect Biden, and there are a few files that we'll be watching. And we have to keep in mind that often during campaigns, what politicians say is not always what they do once they're in power. So we have to keep everything sort of open. But as we move through the Biden administration, we'll be watching a few key components. One is immigration. Canada has had historically a very strong immigration inflows. This year with the border closures, we're running about half our target. The government has sort of tried to compensate for the loss over the next couple of years with more aggressive targets as we move forward. With the President-elect Biden, it's probably going to be more receptive to immigration than what we saw from the previous administration. And that may pose some challenges for Canada achieving these large immigration numbers that are so important in terms of driving overall population growth and labor force growth. So a challenge on the immigration, but we'll see what Biden does. The stimulus plan, so support for the U.S. economy, the polling numbers, as they indicated, a big Biden sweep, we're getting pretty bullish forecasts for how much stimulus would be coming from Biden administration. We've seen those expectations roll back as it wasn't the sweep many had expected. There's still some risks, obviously, and maybe some supports coming with the runoff in the Senate. So there may be some opportunity for more aggressive stimulus. But right now, It seems from earlier expectations of a $2 trillion lift to the U.S. economy, expectation and scaled back to about a $1 trillion lift. But there is more to come, more growth to come, more support from fiscal policy in the U.S. And as that takes place, it'll lift U.S. growth, and that should also lift Canadian growth as we move forward. Another file is energy. Keystone looks vulnerable, obviously, to the extent Biden negotiates any deal with Iran. We may see more supply, so two potential negatives for Canadian energy sector. On the flip side, Biden seems to be a little less friendly towards the treatment of tight oil or shale oil and gas in the U.S., so we may see some offset there. But another key component for the Canadian economy will be very much determined in terms of what happens or doesn't happen when Biden takes over in January 20th. And then finally, trade. At a minimum, I think we'll see a more predictable trade environment. We won't see these random tariffs introduced at an ad hoc basis. I think we've also been encouraged by Biden's tilt to more towards these multilateral trade agreements. Now, for Canada, we're a large exporting nation, but very limited economic and political weight. So we don't do well in a bilateral world when you're negotiating one-on-one with other countries. We tend to do better when a bunch of countries are negotiating together. And to the extent Biden keeps to his word and moves towards more of a multilateral world, that should help Canadian external environment improve as we move forward. Having said that, we also hear discussions with Biden about a Buy American, and what that means is still to be determined, but that does pose some risk. So when we look at the Biden administration, as I suggested, we have to wait and see what's announced post-January 20th. But I would argue it's probably more favorable environment for Canada than what we've become accustomed to over the last 4 years. Now, when we look at the external environment, the challenges associated with it, that suggests to us exports this year are pretty much a write-off. Some gain we expect next year. And with a slow growth environment, a slow global trade environment, and a soft commodity price environment, we're going to probably see investment also be vulnerable, because added on top of all the slow growth numbers we're seeing, we're also seeing elevated levels of uncertainty. And the old adage for investment is, and uncertainty is the enemy of investment, and elevated levels of uncertainty don't bode well for investment going forward. So there are two big sectors in the Canadian economy, exports and investment, that don't look like they're going to be doing much of the heavy lifting as we go forward. So for growth prospects in Canada, it's left to two other components, consumer spending and government fiscal policy. The consumer spending, almost any consumer-related product or indicator you look at has very much experienced this V-shaped recovery, so back above pre-crisis levels, and in many ways shockingly fast compared to other indicators like employment that are still, we've only regained about 80% of the 3 million jobs lost. So most indicators are below pre-crisis levels, with the exceptions being consumer and consumer-related, i.e. housing. And that reflects a number of factors, but I think the key component there is the support from fiscal policy. So yes, we've seen some employment gains that helps consumer activity. We've seen the reopening of the economy obviously helps some consumer activity, but the key driver is the health of the Canadian household. And if you look at the Canadian household, on average, the key indicators you look at, the Canadian household's actually in better shape now than it was pre-crisis. So the savings rate in Canada last year averaged 3%. In the second quarter, it got up to 28.2%. It's come back a bit, but still high double digits. If you look at the debt-to-income ratio, that was the indicator we had been worried about for a long period of time. It just pulled back from 175% to 158%, which is back to levels we saw 10 years ago when we first started worrying about elevated levels of debt to income. And then disposable income. You've probably all seen charts comparing Canadian disposable income to other countries in the G7, and we're one of the few countries that are above pre-crisis levels. And in Canada's case, we're up by about 30%. And the big difference there is the support from the government. So when you look at just the second quarter alone, wages and salaries earned in the Canadian economy fell by $22 billion. Federal government transfers to individuals in the second quarter rose by $55 billion. So the federal government support for the household sector was more than double the loss in wages and salaries. And that explains, I think, much of the lift we've seen in overall consumer activity, in spending broadly, and retail sales in Canada now up about 4.5% above pre-crisis levels. And the housing market in most of the key markets that we look at continue to snap back, and in many cases resale activity again above pre-crisis levels, notwithstanding the fact that the immigrant inflows and purchase of homes have collapsed quite significantly. So we have seen a huge snapbacks reflecting this large fiscal plan support package. Now, as we go forward, these programs will wind down. They delayed the wind down. There was worries earlier that it would all wind down this fall and we'd have that sort of consumer cliff. But the worries have been, the programs have all been extended, so the worries have been mitigated to some extent. But the government can't continue to throw this kind of money at the economy. So as we go forward, support programs will wind down. And as those programs wind down, consumers will live to some degree off the savings they built up, but they'll increasingly need more on the jobs front and employment front. So as we go forward, keep your eye on the jobs market. As the job market continues to improve, that will supply the consumers the wherewithal to continue to support the economy as these government programs wind down. And the consumer in Canada is about 60% of the economy. So if the consumer is not expanding, the economy in all likelihood is not expanding. So consumers are the key to the economy, both now and in the future, but the dependency will increase on job gains. So we need to see continued job gains. And that's one of the issues that we've continued to push with the government. And the government has done quite a remarkable job in supporting or preventing a free fall in the economy with these support programs. If you look at it in terms of overall fiscal support, Canada is on par with what we've seen from most countries around the world. We've tended to be very successful in the consumer support programs, and those programs like the CERB, the Canadian Emergency Relief Benefit, very easy to apply for, and the take-up was immense. The business programs were a little more difficult to apply for, and on a scale GDP relative to what we see in other countries, comparable to the support we've seen in other countries. But where Canada differed is we tended to lean more on loans and guarantees than outright grants. So loans and guarantees, more debt in a time when businesses aren't really interested in taking on debt, is probably not as helpful as grants would have been. And that, alongside of the more complicated application process, probably suggests why the uptake on some of these business support programs hasn't been as aggressive. So as we move forward, our advice to the federal finance is to get the programs that have already been budgeted for out the door, and then continue to focus supporting the businesses, because if businesses don't stay open, reopen, and expand, we won't get the employment gains. We don't get the employment gains. The support for the consumer isn't there, and the economy will be a lot weaker as we move forward. So we have seen some tweaking of the programs. When you look at all the government programs really in place since the start of the crisis, our advice was to err on too much rather than too little. Make the program scalable so you can ramp them up and ramp them down, and then get it out the door before you get it perfect. And what we saw from most of the programs to this day, I don't think any of the programs that's still in existence looks like it did when it was tabled. So the government is course correcting along the way. They do take input, and that bodes well for growth as we go forward. In terms of the overall fiscal support, we all saw the fall economic statement last week. It does continue to suggest the deficit, at least this year, sizable, and even another large deficit next year, and then a gradual trend with not a lot of detail in terms of how they get back to smaller deficits. And we do have to keep in mind those smaller deficits are relative to this year's deficit of $380 billion. Pre-COVID, that we're not seeing anything close to what we used to think as a small deficit, and we're definitely not seeing anything close to balance anytime soon. So continued support from the government. If you look at program spending, the government's size, role in the economy, at the end of the 25-26 projection, it's the same size as it was pre-crisis. So it doesn't look like they're stepping up their overall activity in the economy. Having said that, there is a bit of a fudge factor in there. They do have a placeholder for an additional $70 to $100 billion of additional stimulus, still to be determined. We'll get some updates on that as we get to the spring budget. Which may well be tied up in elections. So there's probably more money coming into the economy rather than less as we go forward. As we look at fiscal policy, debt and deficits, we all look at relative to the size of the economy. So our advice is continuing to be that we need a pro-growth agenda, because if you don't grow the economy, servicing that debt is more challenging. And if we don't grow the economy, there's not much left for redistribution. That economic pie we all share if we don't continue to grow it, there's less to distribute around. So we're hoping to see more pro-growth agenda as we go forward. And that could be, we think, both on the government spending side. So as government spending right sizes, reallocate some of that to a growth agenda. And a growth agenda, we think, would reflect a number of considerations, but I would think infrastructure is part of it. And not just hard infrastructure like rails and roads, but also smart and soft infrastructure. So there's some retraining, some education, and some support for broadband and other investments that help businesses adjust to this new world. And we've got a publication coming out tomorrow looking at a number of the long-term effects that we've seen. And when you ever get a crisis hitting any economy, some trends stop, other trends start, and some trends accelerate. And we've looked at a very diverse impact. So the first round of COVID, broad-based, took the economy down as we shut large parts of the economy. As the economies reopened, some diverging trends have emerged, and even across the board, really. So consumer spending, I mentioned retail spending up on a year-over-year basis, 4.5%. If you look at the components, those businesses that have an online presence have shot up quite significantly. Those that did not have an online presence, the old bricks and mortar, continue to struggle. And that's probably a trend that's going to be with us for a while, as we have seen huge uptake in e-commerce. Demands from consumer will be there as we go forward, and opportunities from the providers will be there as we go forward. If we look at even within the trade sector, energy exports up, energy exports still down, non-energy exports up, services outside of travel up, services related to travel down. Those trends, those high-touch sectors are going to continue to be challenged as we go forward. You look at the job market, there's a differentiation line at $800 a week. Individuals that make less than $800 a week, their employment levels are still below pre-crisis levels. Those above 800 are above pre-crisis levels. So there's a very differentiated impact across the sectors. And that suggests to us the first round of fiscal support, broad-based in nature to prevent a free fall in the economy. As we go forward, we've been pushing for a more focus to continued attention on those sectors that are going to have a longer lasting impact from this COVID crisis. And we saw a bit of that more sectoral focus from the government. And that should, we hope, help turn around the economy a little quicker than would otherwise have been the case. So fiscal policy and consumer spending driving growth near term. And on the monetary front, continued support there, but this really, interest rates are not the tool best sorted for helping the economy in the current environment. They provide a backstop support in terms of keeping rates low for long. And when you look at the Bank of Canada, they've done effectively most all of what they could do, and in line with what we've seen from their global peers. So through March, they cut interest rates 50 basis points on 3 separate occasions, got the overnight rate to 25 basis points, which is the level we got post-global financial crisis. We also saw this time around going down the path of quantitative easing, so the Bank of Canada buying Government of Canada securities. That is something they did not do during the global financial crisis. And so more aggressive action by the bank speaks to the more serious economic challenge we saw through this crisis. So they continue to support low interest rates, overnight rates, by holding the overnight rate at 25 basis points. Governor Macklem, the new governor of the Bank of Canada, has committed to holding the overnight interest rates at 25 basis points until the economy gets back to potential or inflation, the target becomes at risk. The target's at 2%. The latest reading on consumer prices is 0.7. If you just take the Bank of Canada's own forecast and look at the implications from that forecast for rates, it suggests overnight rates are unlikely to move from their forecast basis right through until 2023. So very low overnight rates as we move forward. Market rates will drift higher as markets start to look for a recovery. Worries on the inflation front, which I think will be more perception than reality, but we will see rates drifting higher. However, the Bank of Canada continues to buy Government of Canada securities, which will keep longer-term interest rates relatively low as well. So a very low interest rate environment as we go forward to continue to provide some support for the economy as we adjust through this period. And much of the heavy lifting has been and will continue to come from fiscal policy. And as I suggested, the first round of fiscal support, broad-based, as we move through the second and third phase, we'll see more focused attention on those sectors that will continue to be challenged as we move through the recovery in 2021. Just a quick summary on the provincial forecasts. Post-global financial crisis, 8 of the 10 provinces in Canada declined. This time around, we have all 10 provinces declining. You can't shut large sectors of the economy without having a recession. So we have all provinces in Canada declining this year. And then as we move into next year, we will see growth prospects picking up across the board. Obviously, the COVID shock is a big part of the story, but we can't lose sight of the fact that we've also seen a significant energy shock. So the weakness in across the provinces, the epicenter will continue to be in those provinces tilted to the energy sector. So Newfoundland, Labrador, and Alberta continue to lag the growth tables. And then for Ontario, broad diversified economy, we actually have Ontario outperforming overall growth prospects in Canada this year, and also a quicker snapback as we get through 2022. So a little bit better growth story expected in Ontario. Support continues to be fairly broad with respect to consumer activity, both consumer spending, but also more broadly the housing market. Most of the major housing markets across Canada, let alone within Ontario, continue to be very buoyant, probably continue over the near term, and then eventually we'll see some of that support fade, as much of what we've seen has been pent-up demand, and eventually that pent-up demand gets satiated even in an environment of very low interest rates. So a very challenged 2020, but growth prospects we think will improve quite significantly as we get to 2021, with ongoing support coming from both policymakers, both fiscal and monetary, and that bodes well for growth prospects as we move forward. So Carla and Peter, I'm sure everybody's heard enough from me, so why don't we throw it open for questions and answers and corrections. Thank you for your time.
Thanks so much, Craig. That was a terrific overview. Obviously, there has been a lot going on in 2020. I'm going to encourage everyone to please use the chat function if you'd like to raise your hand, you'd like an opportunity to pose a question directly to Craig, please feel free. And I'll monitor the chat function and moderate questions as they come in, and invite those of you on the line to address Craig directly with your question. But while we're waiting for individuals to formulate some of their thoughts, Craig, you talked about, I do have one question for you, and this is actually an issue that our Political Action Committee has been looking at very carefully and closely to inform our advocacy agenda. You mentioned the pro-growth agenda and how important fiscal policy is going to be, the key role that's going to play in our economic recovery moving forward. One of the gaps that we keep hearing from our members and folks across the business community is that there doesn't seem to be a lot in terms of programming and support to support those new businesses that might be emerging, that have identified an opportunity where there's either a market innovation opportunity, a service delivery model innovation opportunity. And there just doesn't seem to be much that has been targeted to that segment of the economy to incentivize entrepreneurs. And much of the relief to date has been really focused on pre-existing or established businesses. Is that something that you can maybe share some thoughts or insights or ideas on?
Yeah, I think so just as a backdrop, as I suggested, where they could have improved was the support programs for businesses more generally, and that seemed to be a bit reluctant at the start. Unlike the consumer side, it wasn't overly generous initially. It did get ramped up, and again, as I suggested, it focused on loans and guarantees at a time when businesses weren't interested in taking loans and guarantees. So we heard that consistently from our clients, that they're really not interested in taking on additional debt at a time like this. And the U.S. went the other way, similar in terms of overall size of support for businesses relative to GDP, but more a tilt to grants. And they still haven't bought into that kind of thinking there, even with the latest program. It's again about government guaranteed loans rather than anything on the grant side. So I think that's beyond that to throw grants at the business community, unfortunately. Now, I think when you look at the support as we go forward for a pro-growth agenda, we do think, I suggested government has a role on both government spending and the tax side. On government spending, it's focused on infrastructure, and that's the smart, soft, and hard, and maybe that's where some of these pro-growth businesses get covered. The challenge for small business Well, we saw that with this government under Bill Morneau, any tax changes, the small business community don't go over well, as he learned quite acutely. So they're a bit puck shy in addressing the small business. But one area that we've suggested over the years, and it's probably a little more complicated, but maybe it's now's the time to introduce some of these changes, is that when we look at the support for small business across Canada, what we think there is an opportunity is to target the small business support to new businesses, not old businesses. So then you get, some are definitely not interested in growth. So maybe they don't need the tax incentive. Some businesses, small businesses, individuals, perhaps, and the government looked at that to some degree. Maybe there is a tax play there, and small business people should be focused on their business and not arbing the tax system. So maybe simplify the tax system there. And then looking at the growth opportunities, and that's where we've always had a challenge in Canada. We're very good at starting small businesses. We're not very good at growing small businesses. And we looked at this back in 2002 with the Canadian Manufacturers and Exporters and the Canadian Federation of Independent Business. And what we found generally is that businesses, one of the biggest challenges, barriers to growth, was the regulatory environment and the tax environment. The regulatory environment, a small business with 10 people have some of the same policies required for a business of 85,000 employees. And that doesn't make a whole bunch of sense. Training opportunities for small business. There's an opportunity there, I think, to support training in small businesses because, given the uniqueness of any business, if you have a new individual you have to train, invariably it's being done by the person next to them. So when you bring one person on in a team of 10, you end up having 2 people involved in training, which again takes away from the business. So there's some areas like that, and I would argue taxes has to be part of the solution. And they are moving a bit more to a differentiated support program on the spending side. So maybe now's the time to look at it. But as I suggested, a lot of these changes, e-commerce, e-health, e-education, it's going to require a huge skill upgrade for some businesses. And we've seen that in the retail sector. Those businesses in retail that had an online presence recovered fairly quickly. Those that didn't have an online presence that adapted quickly to get one have recovered. And those that are left behind are the bricks and mortar that don't have the online option. And if the online option does require some skill and does require some technology advancement. So, some of these pro-growth tax policies would have to look at some of the new growth and new entrepreneurs in the new economy. And that's sort of the point we've been pushing. And when you look at the talk of tax increases, well, our first point is now is not the time to see tax increases. So, the economy is recovering, but it's still tentative and still vulnerable. So you wouldn't want to sort of knock the economy down in the early stage of recovery. So now is not the time for broad-based tax increases. And then as we move forward, if there is a need for tax increases, we'd like them to look at the tax system holistically. So now is not the time to raise taxes. Take the time to look at the tax system and make sure the tax system is set up for the economy of the future rather than the economy of the past. And that's where I think some of these new business models could use some support that right now is broad-based for all small businesses. And maybe we could use that money a little more effectively for those industries that want to grow rather than those industries that don't necessarily want to grow.
Thanks for your comments there on those items, Craig. And your last comment about a comprehensive review of our national tax system is very much aligned to an advocacy position that the Canadian Chamber of Commerce has taken for some time. So I appreciate your comment on that. We have received a couple of questions through the chat function. One is focused on residential real estate markets, and we'd love to get your thoughts on the long-term impact for the commercial real estate market with the work from home trend and the reduction in the need for large commercial spaces by many employers. What are your insights or thoughts? And Tamara, if you want to weigh in or expand on that, please feel free to. Love to hear from you.
Sure. So in terms of the trends, the work from home is another one of those trends that I mentioned we're looking at as sort of more persistent than some of the other ones. We're not going to be all doing webinars from our basement forever, I hope. But we are seeing a fairly sizable increase. And Stats Canada looked at the number of individuals in Canada working from home, I think it was April or May, the number was 5 million people working from home. 3.5 million of those people had never worked from home. And, as we return, as the vaccine rolls out, we see people go back, I think it won't be sort of all back to the way it was, and there'll be a bit of a hybrid model, so there'll be a little more flexible. So for commercial real estate, there are some pretty dire predictions in terms of the outlook for commercial real estate. In most of the major cities, we started from a very strong position, a very tight commercial real estate space, so that bodes well. As we go forward, we will be seeing fewer people, in all likelihood, on a daily basis in any given space, which sort of points to some of these dire outlooks for commercial real estate. Having said that, offices still have a place, and there's still sort of a function of office and collaboration and the like. And I think that we'll also, we've for decades gone from 300 square feet per person down to 100 square feet per person. We'll have to have more space around every individual. So for commercial real estate, fewer people in the office on a consistent basis, but more space around those individuals, which probably suggests it won't be as dire as some of those forecasts that don't account for the fact that we are in this so-called distance economy, where we're going to need more space around people than we had in the past. So a bit of a reversal in that square footage per person, offsetting some of the decline in the outright numbers on a sustained basis. But we do still believe it will be a hybrid model. People have become accustomed to it. We have seen some fairly significant uptake, and I think businesses are adjusting plans based on that. But some of the more dire predictions, I don't think, take full account of the fact that we'll have more space around any individual.
Thank you. Tamara, did you want to weigh in?
No, thank you. That touched on it quite well, Craig. Thank you very much. I think the only thing that I was curious about is if we're going to potentially see a shift in zoning use, and a shift from some commercial spaces that might look at more of a need and towards perhaps affordable housing, or shifting to some residential multi-purpose use. That's where I was kind of curious if we're going to see a little bit of that if we do have excess in commercial real estate space out there.
Yeah. So just related to that, the Robert Hogan, our team, did a piece on 7 trends in the housing market. And, one of the trends that we have seen, and it's across Canada, is there are a few trends. One, to your conversion point, is when you look at the impact of, COVID and the work from home mindset, is there's been a differentiation between multifamily and detached homes. So even in Toronto and major city centers, what you've seen is the detached homes, more space. There's been a demand for that. Whereas they're moving out of the multifamily condo setup. The other component is when you look at the weakness in the job market and the closures of the borders, we've seen immigration levels about half of what they were. Some of them were renters. We've seen students collapse in terms of foreign students. Some of them were renters. And when you look at the sectors hardest hit, food, accommodation, tourism related and the like, they tended to be renters as well. So there's a great vacancy opening up for a lot of these condos. So I'm not sure the demand for the conversion will be there, but maybe longer term as we move back. Having said that, people are looking for more space, so that puts premium on residential, on detached homes. And we've also seen people move for more affordable options outside. So there has been a transition that looks like it's here for a while, a move from the urban settings to more rural settings. And we've got a chart in the document we're putting out tomorrow. Is you look at Toronto, Montreal, Vancouver, house prices have shot higher. And then you go 50 kilometers outside, house prices have shot up even more. And then you go another 50 or 60 kilometers and prices are even further up. So that's an issue, I think, as we go forward, is the rural, the move from urban centers to less urban centers is going to put some strains on the housing market and the infrastructure in those smaller communities. And that will be, I think, a challenge to navigate as we go forward, as people look for space and affordable options, which tend not to be in the major city centers.
Thank you. So I'm now going to turn it over to Bob Elliott. Bob has submitted a question via the chat. Bob, did you want to speak to your question, or would you prefer that I can read it out? I know that you're interested in hearing Craig's thoughts on the growing tensions with China and the impact on both the global economy and Canada specifically.
No, that's fine, Carter. That was my question, Craig. So just to reiterate, there's a lot of tension, obviously, globally with China. And just curious your thoughts in terms of impact on the economy, both globally, but Canada specifically.
Yeah, so, well, a few things. So, China is a large player in the global economy. And when you look at the snapback they've had, it's very much a V-shape. They had the crisis earlier and the recovery has come quicker for them. And that's reflected in the pickup we've seen in non-energy commodity prices. And with that, we've seen some sectors of the Canadian economy actually get back to pre-crisis levels. And that's the non-energy commodity exports relative to energy exports. So we're seeing some benefit of the quick turnaround there in terms of overall growth for a very significant player. The other component is, we've for decades looked at diversifying Canadian exports and diversification. We used to be exports to US were 85%. Now they're all the way down to 75%. But our number 2 trading partner is China at about 8%. So they are our second largest trading partner. If you have the UK, in the old days when the UK was part of the Eurozone, well, maybe they still are and may well be maintained, but they were 8%. So, if you split them up, it's 4 UK and 4 Eurozone. So China is number 2. And what we've seen, not just from the US, but from China, is this bilateral negotiations that have taken place. And Trump was, he was known for that unilateral aggressor and bilateral negotiator. We saw that with the reworking of the USMCA. He didn't do it as 3 countries together. He did it one-on-ones. And China's a very same mold, and that poses a challenge. And that's the point I was speaking to in terms of, for Canada, we do better in a multilateral world. Rather than bilateral world. And so the America First or America Alone platform doesn't help us. And I think as we move forward, to the extent that Biden keeps to what he said through the campaign and more of a focus on multilateral and organizations and a multilateral view of the world, then I would think we probably have better chance at getting China to play by the rules that many others already play by if we have a group of like-minded countries negotiating with China rather than a small economic or political weight like Canada trying to do it on our own. So I think prospects will improve as we go forward with a change in the U.S. administration. And that does, I think, hold prospects for Canada improving. But obviously the politics there is quite a challenge. And we've seen it in Canada for a number of years. And you can see it in Australia-China relationship too. It wasn't long ago that the talk in Canada was, let's get a deal, a free trade agreement like Australia has with China. We just take the Australian deal and strike out Australia and put Canada in there. And it's, commodity dependent, big country and relative to small country. And Australia is suffering all kinds of challenges that we now, I think, better appreciation that free trade with China doesn't always mean fair trade with China. So I think we need to do it on a multilateral basis. And that was something that was talked about just as we were moving that direction until Trump came in, and it was the G7 meeting when he basically sort of threw it out. Everybody was looking together collectively to try and get China to meet some of their commitments in terms of WTO and the like. And then he opted to pull out of all these agreements, and that wasn't helpful. So we've lost a few years, but hopefully with President-elect Biden, we'll get back to more of a multilateral approach to the world and a fuller appreciation that if everybody's playing by the rules, everybody can do well. It's not a zero-sum game.
Super. Thank you.
Thank you, Craig. Now, you mentioned a document that RBC is publishing tomorrow. Can you share with everyone on the line what they can expect to see tomorrow?
Yeah, sure. So we've got, at the end of every year, we do a publication navigating the year ahead. So navigating 2021. So we've got 21 charts that we've looked at and sort of implications for businesses, investors, and individuals on a go-forward basis. And these are some of the charts we've talked about that I've mentioned in my comments. Huge uptake in online retail. Canada lagged the US and other countries, and we've closed that gap, and that's probably with us for a while. Individuals more comfortable shopping online. Providers have more online options in Canada, let alone the big players. So that's going to have different impact on different sectors of the economy, consumer behavior, but also more so on the retail side to your question earlier, Carla, about, tech adoption and the like. That's one area that's going to continue. The gaps in the labor market, and they suggested huge inequality component to it, inequality of income, of wealth, and of opportunity, and those are things that need to be addressed as we go forward. Canada's only strong as our weakest players, so we need to get everybody up to a higher level, and that's going to provide some attention from policymakers, but also some more thoughtful approaches from businesses. Female participation rate, that's sort of been an issue in Canada. We first wrote on it 15 years ago, and we, through the COVID crisis and the impact on certain sectors, there was a huge fall off initially in female employment. So that she session talk that everyone has seen. But as we've seen employment recover, the employment levels of women have recovered equally to the employment levels of men. But what we are seeing is a fall off in female participation rates, and in particular women of childbearing age, which suggests to us that childcare affordable childcare is a policy priority, and that's sort of the challenge there. And with that, just doing the simple math, if female participation rates got to male participation rate levels, it would add 1.7 million women to the labor market, and that's at a time when you look at the speed limit for a Canadian economy or any economy, it's labor force input and how productive we are using it. So labor force growth plus productivity. Productivity has been a sore point, a weak spot for Canada for decades. With the weakness we're seeing in investment, it's not going to improve anytime soon. So any growth for Canada has to come from labor force growth. And we've seen immigration levels come off in major city centers. Most of the population growth in recent years has come from immigration. So that's a soft spot. So to us, it makes perfect sense to try and get more females into the labor market, because that raises labor force, which is what grows the economy, that makes fiscal deficits sustainable and makes more money available to share around the economy. So there are a few, we just look at a number of components that we see sort of lasting trends emerging and implications for that. And as I suggested, it does support a more sectoral focus from the government, and that's a document we'll be releasing tomorrow.
Thanks so much, and we'll make sure that we share that document with everyone participating today. I'm sure they'll be very interested to see that, so thanks for those highlights. You mentioned the sectoral approach, and last week, as part of the federal economic update, there was an announcement about the creation of a new credit availability program for highly affected sectors. And I think that announcement aligns with a question that Elaine Gary has submitted through the chat about, how can the government help restaurants and bars, those that are independently owned, that are so at risk and so vulnerable right now? And Elaine, please feel free to jump in here if there's additional context that you'd like to share to inform your question.
Yeah, it's so the discussions, we have discussions with the finance minister in advance of the fall statements in the budget. So I had my discussion with Minister Freeland a little over a week ago. And so through the work we've done for this publication we're putting out tomorrow, as I suggested, it's really a differentiated impact of the economy and the recovery. So not all sectors are recovering, and those sectors that aren't recovering are those high touch sectors, and food, accommodation, tourism, and the like. So the advice I gave the minister was that traditionally I'm not a big fan of governments taking a sectoral approach. Governments traditionally do not have a good track record at picking winners, but losers have a good track record of picking governments. So it's never been a good idea for the government to sort of try and pick what sectors winners and losers. And we're not saying that. We're saying this is a longer lasting impact from this crisis for a number of key sectors of the Canadian economy. So this is exactly the time you want a more focused approach from fiscal policy to get more bang for your buck on those sectors that need more of the lift. And that's where I think some of this highly affected, I forget the acronym they had for it, but I think that's where it came from. So they are, I think, aware that the tail of the COVID crisis will be longer for these sectors in a distance economy. They're going to continue to face challenges, and well after the vaccine is rolled out and has fairly significant take-up. And so we've suggested, and I think they've heard, some specific attention is needed for some of those sectors. The challenge there is it's really It's more of the same. It's a loan, and businesses at a time of a crisis do not have much interest in taking on more debt, even with rates low. And I mean, we saw that during the global financial crisis. It was never an issue of the supply of credit or the price of credit. It was about the demand for credit. And businesses aren't inclined to take on loans, which is perfectly acceptable in a recession environment. And during the earlier launch of the programs, the CEBA, which was a loan, $40,000 loan with $10,000 forgivable, effectively a negative interest rate. And the take up on that was slow as well. And so the feedback we've been giving them, and I suspect others have, is businesses that are not interested in taking on loans. So they got part of it right. It's a focused approach, but it's still very much a loan. And that, to me, will probably limit the uptake on it again. And if you look at, we did a piece on the small, medium-sized enterprises and looked at some of the challenged sectors. And unfortunately, when heading into the crisis, it's the most vulnerable were those with high debt levels, low liquidity levels, and high fixed costs relative to overall revenues. And many of the sectors that have been impacted harshly and will continue to be impacted were the most vulnerable heading into this crisis. So I think, you know, to their credit, they've got a more sectoral focus than they had in the past, than the broad-based plans. But again, it's the same challenge we saw with the earlier plans, and that is a heavy tilt towards loans and guarantees, which, you know, businesses aren't looking at taking on more debt right now. They want more help.
Well, and thank you for that comment, because that's certainly something that we have been hearing from our members, that loans are not necessarily something that are attractive in terms of trying to sustain businesses. Although there was some excitement that the CEBA loan, the additional $20,000 with the second $10,000 to be forgiven, will meet with some approval. That opened on Friday. And also, thank you for your comment about the acronyms. HASCAP, I think, is the latest addition, Highly Affected Sector Credit Availability Program. I certainly have to write them on my hand now between CEBA and SUSE and all of the others that have been released. So thanks for that. I think we'll do a last call for questions. I think Peter may have had a question that he wanted to pose to you, and if anyone else has anything that they'd like to hear from before we wrap up, please don't hesitate to insert it into the chat. Peter?
Great, off mute there. Craig, just a comment. You had mentioned two key factors around recovery being increase in consumer spending, and then the fiscal stimulus that we've seen over the last 10 months. Obviously, you had mentioned consumer spending being up over 4% year over year, higher than pre-COVID. What, like in terms of that sustainability, what's your perspective on that once the government programs subside or we start to decline that, and then, you know, from there, where do we go in terms of that recovery?
Yeah, so I think so the consumer. It's as I suggested, the consumer on average is in better shape now than before the crisis. So that reflects the transfers, substantial transfers we've seen. As I said, double the loss we got in wages and salaries. If you look at the disposable income year-over-year gains, Canada is a leader among the G7. Many others are flat. So that speaks to the success the federal government has in getting money into the hands of the consumer. There's still work to be done there. I think Minister Freeland has been publicly asking for any suggestions, and maybe this is something to go back to the discussion in the retail and restaurant space, is to how to free up some of that money that consumers are sitting on. And by our calculations, it's in the tens of billions of dollars sitting there. And they've looked at in the past, I suspect, at vouchers and things like that to try and get people out, and they can do that in a more focused manner. So there may be still more support to come from that sector. But as we moved into the crisis early on, the support programs were all going to wind down this fall. Bank deferral programs were all going to wind down this fall. Our concern was that there'd be a consumer cliff, and as the programs wind down, as deferrals programs come down, it'd be a harsh reality for consumers, and that would sort of give us a second dip in growth. They took that on board. They listened to the concerns of the consumer cliff, and we saw some extensions through this year, and now more recently some extensions even through next year. So now it doesn't look like it's going to be a consumer cliff. It's a slope, a gradual slope of these programs winding down for the consumer. And that's where the point that I've been making with them, and the point I hope I made with everyone on the call today, is that this is the time to get the business support going and getting it right, because governments don't create jobs, businesses create jobs. And if governments can get businesses supported so that they stay open or able to reopen and grow, that's when you get the job gain. And the job gains will drive consumer spending going forward. The programs will wind down. We know that. The dates change a bit, but they are going to wind down at some time. The government can't run $380 billion deficits indefinitely. So we'll see these programs winding down as we go forward. And the success of the consumer and the economic outlook going forward will be driven by the success of businesses and their ability to hire. And as I said, we've seen a good bounce back in employment, but we're still 80% of where we were as recently as February. The unemployment rate in February was 5.6%. We got up to 13.7. We're at 9. If we're right, that unemployment rate is going to continue, 8.5% this year, and then move down to that 7.5% by the end of next year. So directionally an improvement, but still higher than we were as recently as January and February this year. So it's to us, the priority has to be on getting what's budgeted and additional support to the business community so they can not just survive, but thrive going forward, which means we'll see employment gains, which gives the consumer that next leg of support. And the consumer right now is in a good starting point. Savings rates elevated, those tens of billions of dollars. As we go forward, consumers can live off that as the programs wind down. They can pay their taxes on some of those support programs that went out on a pre-tax basis. They've reduced their debt outside of the housing market. That's a good news story. That's a debt to income ratio moving lower. So the consumer is in decent shape. It's not evenly shared. When you look at the savings, it tends to be a tilt to high income households. And they're the ones that can't travel or can't go to arts, entertainment, and the like. So not evenly shared. Some people are still running out of paycheck before they run out of week. So there's still some needs to support certain sectors within that. But overall, I think the attention has shifted to the business community. I think that's the right thing to do. I just hope that lessons learned from the past in terms of more on the grant side and less on the loan side will come. And it's still early on. But as I said, every other program they've taken input on, and they continue to hear from us, and I'm sure others, that it's not a loan issue. People and businesses aren't in need of more debt. They're in need of more support. So we continue to push it, and I know the Chamber and other organizations continue to push it. And they've course corrected on any other program, so they're a little more reluctant on this one, it seems, but I think we have to keep pushing.
Thank you. So we have one final question before we wrap up from our lifetime member, Rick Burgess. And he's wondering if you have any data or thoughts on the expected impact on charities and nonprofit organizations. They have been eligible for some business supports, but many have been challenged in demonstrating eligibility or meeting the application requirements. Any final thoughts to share on that?
But I think it's a similar trend we've heard from all businesses, is that these programs are overly complicated and complex to get. It doesn't make the money get out the door quicker. So to our criticism of the government, they've done a phenomenal job. I mean, they introduced programs that used to take years to put together, and they've done it over the course of weekends. So phenomenal job generally, but our view is, we have to figure out a way to get business support programs as successful as the consumer support programs were. And part of that's application process. The application for the Canadian Emergency Relief Benefit, if you could fog a mirror, you got a CERB. Not as easy, obviously, for the business side, and also that loan tilt relative to others. But the charitable sector continues to be challenged. I mean, you can look at charitable giving through the economic cycles, and this is one of the worst economic cycles we've seen in some time. So pressure is very intense on that sector from a cyclical perspective. To the extent they can make themselves, they can get access to the support programs. I think that'll buy some time, but the government really hasn't looked at that sector uniquely yet. And I think in some way they think they have sort of taken a place of some of these sectors, which is maybe a short term, but they cannot do it on a permanent basis. So hopefully those business programs, again, get easier to apply for.
Thank you so much. So how quickly an hour goes by. Craig, I cannot thank you enough for sharing your insights today. We really appreciate your time and the wisdom that you've shared with us. So thank you so much again for joining all of us.